Welcome back to Closing Bell on the 10th of November 2020 on a Tuesday. And the technology stocks, the hypergrowth stocks, are still on a sell-off. Very aggressive rotation going from one area into the recovery stocks. When I say recovery stocks, they're basically airlines, hospitality, shops, REITs, retailers, all the COVID-19 injured stocks. But this video today, I want to give you value. When I say value, meaning you need to know there's no value trap when you want to buy these rotational stocks. I know everybody's going on the roller coaster and they're jumping into the bandwagon, but I want you as an investor to understand. So today I want to introduce a ratio called price to earnings ratio, PE ratio, which you could find Yahoo Finance or Google Stock. It's basically a ratio they use to gauge whether that stock is expensive, cheap or affordable. PE ratio between 5 to 10 is generally for cars manufacturer like Toyota, BMW, all this kind. So between 5 to 10 to 11, 12, that's where used for stock for car manufacturers because they have very constrained margin. That's why that's the P ratio by rule of thumb. So any P ratio between 10 to 20, 25, those are dividend stocks, normally like banking stocks, REIT stocks, like Procter & Gamble or Unilever, some about like 10 to 20, 25, okay? If they're a bit more 25 to 30, that means they're still growing dividends. That's the gauge. But if you see any stocks beyond 40, 35 to 60, 35 to 60, they're still good growth stocks, 35 to 60, like Apple, Microsoft, Facebook, Nvidia. But if you see any stocks that's between 60 to 100 onwards, that means those stocks are hypergrowth stocks. Like Amazon is still hypergrowth, Netflix still hypergrowth, they're still growing. So there's still stocks that are growing, they're reinvesting their capital back in. Okay, now back to the topic. I've explained what P ratio is, but I want to explain how to use the P ratio. So the formula for P ratio is the price that you see on a particular stock over the earnings per share, the EPS, which I speak about every time, earnings per share. So let's go to TripAdvisor. One of the more popular recovery stocks been jumping. It's been roaring. If you see the P ratio for TripAdvisor, when it's healthy, when it's all perfectly healthy and fine, it's about 30 to 36 because it's still a growth kind of stock, slowing down, but it's still a good growth stock. The price just now is at 27, okay? There's still room to climb to 40 to 50 when it was before COVID-19. But think about it, is 27 good enough? Remember, they're not making profit. So the PE ratio for Trip is 0 because it's negative. So if you got the price of 27 divided by a negative number, you get basically 0. You don't get anything. But think about it. If it's 27, they start making profit, 0.1. So if they go 0.1, stock price is 27, it would be worth 270 PE ratio. So you're talking about before 30 to 270, that's multiple times. So you have to be careful. So it will take TripAdvisor to make EPS 0.1, 0.2 up to at least 1 before they can maintain that PE ratio of 30 at a price of 30. So I hope you get the gist with me, okay? So do you want to invest in TripAdvisor who is still good upside, but it will take time for them to make money back when everything opens, when people are comfortable going back in traveling. Let's look at BA, Boeing. Boeing had a PE ratio before COVID-19, before all the drama, air flights crash of 300, 350. The super growth stock. The EPS was about 17. Great, they're making money, they're raking in. Chinese was buying lots of airplanes. Now their price is at 187. And you think, whoa, there's almost a double upside. There's almost 100% conversion. Think about it again, EPS at the moment is 0, they've lost a lot of engineers, they've lost a lot of contracts, no airlines coming, no airlines buying any aircraft from them. When are they going to buy next? So let's say they start earning EPS, they start breaking even at 0.1. Let's say they start breaking even just to get away from 0. Then 187 divided by 0.1, it'll be 1,870. That's like 6 times more than the 300 PE ratio. And they will have to make an EPS of 1. They need to start selling planes. They need to start getting engineers, they need new design, start getting production ramped up. How long will that take? 1 year, 2 years, 3 years? I'll let you decide. So understand what you're paying for before you start going, yes, let's go catch on the train. Let's get back into business. How about Carnival? Like I mentioned, Carnival stock price is 16, P ratio 40, and when it's high, it's $40. So 16. Let's say they break even again. When they break even at 0.1, P ratio will be 160. So from 40 to 160, You know, it's 4 times. You're paying multiple. You're already paying 4 times the price on that 16 of the previous P ratio. But let's bring some good ones, okay? Good ones which you should consider, okay? Okay, let me bring 3M, okay? 3M, P ratio, they're making profit during this COVID-19, making profit. So the P ratio on a good day was 20, okay? When 3M was depressed pretty low before all this rotational stock, their P ratio was 15. Okay, and now today I've checked, the P ratio is 19.16. So that actually the price that you pay for 3M now is actually the same P ratio for before COVID-19. So would you still pay more money for 3M? Assuming that 3M will recover and sell more stuff and get back to rotation recovery, then it'll start bringing the P ratio down and price starts going up. So maybe you can get 3M. But at the moment, you're already paying for the price that's equal before COVID-19. How about Caterpillar? Caterpillar has surpassed its previous high before COVID-19, 170. The P ratio previously was about 13 in Christmas. And now the P ratio is about 28. It's almost double. So would you still pay for Caterpillar? I know folks say it's a great stock. When mining comes back, they're going to make more money, more sales, more revenue. But you need to understand what you're paying for the money now. You know, that's what this investor will be, institutional investor will be thinking. Let me bring a last one, Berkshire Hathaway. Berkshire Hathaway, you know, normal before COVID-19, the P ratio was 18 to 20, okay? They don't pay dividend, but it's slowly slowing down, you know, good stock, defensive sector. Now the P ratio is about 30, it's slowly dropping to 24, okay? Maybe they're getting more profits as a company. So you're actually paying 24 over previous 18 to 20. So would you still pay for Berkshire Hathaway? But you know, Berkshire Hathaway is a good stock, you know, good company, it's got Apple and everything. So it's something that you need to think about. Something to think about. So that's the PE ratio, price over the earnings per share, that you need to consider. You need to calculate where you are. I use a website called, I think, macrotrends.net. I'll leave the link below. It's free to use, that you can check the historical PE, the historical EPS ratio, and you can put it in. Before you buy, you need to consider. Don't just follow the trend. You need to understand what you're paying for, okay? So just before I go, if you were to ask me, Alex, okay, I always give you guys value. If you ask me today, Alex, what rotational stock would I buy, okay? I wouldn't buy it now because I ran out of money. If you give me $1 million, what would I buy, okay? These are the 3 ones I've thought really, really long. This 3 one I would buy, okay? 3 or 4. I'll buy McDonald's still. McDonald's, great earnings. With COVID-19, they're doing well. Without COVID-19, they're still doing well. Technological play on McDonald's. They use technology really, really well. And I don't need to say much more about how I use the app, the takeaway and deliveries. And the second one is Nike. Okay, you can see Adidas and Under Armour trying to catch up, but Nike has been prevalent. They have been great during COVID-19. Digital sales, they don't even need to go to retail. They just sell directly to you from the online. They're cutting costs. And Nike's got play. And then Sports Cup getting up, campaigns for advertisement and things starts getting up again. You know, how high can Nike go? With digital sales and retail sales, they're going to double, they're going to grow. And the next one, like I said, Berkshire Hathaway, it's a pretty good stock. So once all, you know, they dumped all the airlines and banks, and they'll be buying back their stock. So they've got lots of injured stocks away. They've got lots of cash that might buy quality companies after on the recovery. So, you know, let them manage your funds. So this is the 3 that I can think of today as of the 10th of November 2020. Okay, this is the end for me now, but this is only the part 1 of the video, okay? I was so much to speak, I need to cut it into 2. So the second part of the video I'm going to be speaking about is about the growth stocks, hyper growth stock. What am I doing? What have I bought today? What have I sold? What am I doing with the likes of Fiverr, Pinterest and all? So I'll speak about it in part 2. So stick with me, check out part 2. And if you do like this video, leave a comment below and press the thumbs up button just to show your appreciation on this video. Okay, see you soon. Bye.